Hello, I'm Greer Lynch, Head of Marketing at Leaf Logistics. Today, we'll hear from two leaders in the transportation industry, and they'll speak to you about the root causes of market volatility in our industry and what shippers and transportation providers might expect in the months to come. With that, I'm pleased to introduce you to Chris Pickett, Chief Operating Officer at Flock Freight, and Anshu Prasad, co-founder and CEO of Leaf Logistics. Welcome to you both.
Thanks, Greer.
Great. Anshu, I'll hand it over to you to get the conversation started.
Thanks again. Chris, great to chat with you about this. And I know this is a topic near and dear to your heart. You've written extensively about the freight market cycle over the years, some of your work that we reference often here at Leaf. Mm-hmm. What do you believe are some of the underlying factors that cause these repeated shifts between loose and tight markets?
First, Anshu, thanks for having me. Great to be here chatting with you guys. And your point, yeah, I've been, paying attention to these market cycles for the last 15 or 16 years. It's become a borderline obsession. And I think the most glaring kind of insight I've kind of taken away is as wildly volatile as this market can seem, case in point. And so it's been kind of the definition of the last 3 years. We seem to follow a pretty consistent 3-year drumbeat. We're just based on the fundamental structure of the US trucking market. There are periods of episodic incline, right, where rates go wildly inflationary because there's more demand than there is, trucks to fulfill that demand. We go to the market, buy more trucks come in, put a cap on the market. That sends the market over the falls. We reach a period of kind of peak inflationary, year-over-year spot market rate conditions. Too much cap comes in, and over the falls we go. And we end up kind of bottoming out at a trough. And I believe what we're feeling right now is evidence of the trough in this current spot market rate cycle, till eventually enough overcosted capacity has no choice really but to exit, puts a floor under rates. We hit our deflationary inflection point, and the market repeats itself. And what I believe creates this almost jarring kind of consistency, to my point earlier, is just the fundamental nature by which this market functions. And by that, I mean how profoundly fragmented it is. It's the US trucking market. You see these numbers thrown around a lot, $850 to $875 billion. Massive marketplace, but incredibly fragmented on both sides, but specifically on the supply side. We're over 1 million, or 90% of the over 1 million FMCSA registered motor carriers operate fewer than 10 power units, right? So it's the land of the long tail marketplace. And because of the super low barriers to entry and exit, and the relatively low economies of scale, right, which means that this industry kind of resists consolidation, we get these periods of, because it's so easy for capacity to come in, when market conditions are positive, new capacity comes in, just as easy for that capacity to exit. When the going gets tough, that capacity exits, and it kind of puts us almost in this, the almost depressingly consistent cycle of lemmings over the cliff. And so what causes that is, one, just the profound degree of fragmentation, super low barriers to entry and exit, and I would argue just the fundamental structure by which freight is procured. So you have a spot market cycle, which is wildly volatile, plus or minus 35 to 45%, on a given year, which is crazy. But not everyone is out exposed to that spot market, right? Any shipper of any meaningful size with contractable freight for sure doesn't want to be exposed to that wild volatility. So they're out, trying to source capacity more consistently, like they would other kind of key input materials like cans or packaging or ingredients or whatever the case may be. So they're out doing their annual bid. And the annual bid, tends to run on a 1-year fiscal cycle, 1-year fiscal term. And that 1-year term conflicts with the 3-year spot cycle. So just the underlying structure of the market is further exacerbated by the way in which truckload capacity is bought and sold, which I believe kind of sets us on this, consistent course of, 3 years, overshoot and collapse, rinse, repeat. Let's get ready to do it again.
Yeah, so that's really interesting. Of the factors you just walked us through, which of them do you believe are sort of static over time? Which do you think will go away over time, should be kind of worked out of our system?
Yeah, I mean, you kind of question, why is this industry so fragmented? Why are there limited economies of scale? And that's maybe a topic for a different webinar. But I think those conditions that drive that aren't going away anytime soon. And a lot of that's driven just by the lack of regulation. Right, when the market was deregulated in the early 80s, this to some degree, for better or for worse, is a bit of the result. And what drives those low barriers to entry, and I would argue the barriers to entry are actually getting lower. I think one of the perhaps unforeseen consequences of digital transformation has never been easier to get freight. Any carrier that wants to get in the market, if they've got, a smartphone, right, has access to like hundreds of thousands, quite literally, of shipments on a given day. And so it's much easier for these new operators to come into the market, get a CDL, lease a truck, get their operating authority, have access to, for the most part, a lot of the same opportunities that larger scaled, more experienced operators, have access to. I think that over time has the real potential to actually exaggerate the amplitude of these cycles. And I think we saw that case in point in 2020 and 2021. And so, fragmentation, low barriers to entry and exit, barring any kind of material innovation from a technology standpoint or any radical change from a regulatory standpoint, I don't see those things changing anytime soon. The third, though, I would argue that I think the nature of by which transportation capacity is procured, I think there's massive opportunities for improvement. I don't think I've ever met a carrier or a broker or a shipper in this industry who said, I love the annual bid cycle. I love going out to market. I love going and procuring freight rates and then trying to deal with whether those rates hold or not. So there's some fundamental tension between, just by definition, how bad some of the sales forecasts are that drive the procurement strategy for capacity. They're almost doomed to fail. And so I think that over time, as technology improves, as forecasting improves, as the procurement process improves, I think new constructs will arise, right, that just create more inherent flexibility into the nature of contracts, either with shorter terms or more flexible conditions, such that either party is not having to take on a disproportionate share of the risk. What happens when you're on the front end of the upcycle is oftentimes the buyer is going to take a disproportionate share of the risk. They're going to lock in contract rates. Spot market is going to surge past contract, which creates a real financial disincentive for that underlying carrier to hold that contract. Eventually, routing guides fall apart. Shippers spend more time in the spot market. Or contract rates get reset higher as a result. And then at that point, oftentimes it's the carrier that's taking the disproportionate share of the risk. Spot market collapses. Shippers go back into market and say, wait a minute, I have an opportunity to go out and do mini bids or buy at relatively lower rates. The legs get cut out of the underlying carrier. Both sides remember, and we kind of go into this kind of recurring cycle of, either side kind of wants their pound of flesh based on what happened the last time. And I think that technology, that new operating models, that new ideas by which to enter into these freight contracts, I think certainly has a huge, at least potential to resolve some of that.
Yeah, I mean, you pointed out several sort of challenges with the RFP process, and yet we still see that as the predominant way, and you referred to this, for shippers to set up their sort of what's called contract freight plan or set up their budget. What's a shipper now staring at sort of, you mentioned the last peak was a couple of years ago now, so we're kind of thinking about, no one has any great prognostications exactly as to when the market turns, but it will turn. How should a shipper insulate themselves from what's inevitable, which is a tightening of the market and sort of the destabilizing effect of that you just kind of alluded to before?
Yeah, I mean, I think I look at 2023 as a bit of a repeat of 2019, right? So that's the last time we were down in the cyclical trough. Pre-COVID, we hit our turn, and then 2020 and 2021 were very different markets. So I would expect 2024 to be some version of kind of what we saw with really 2021. And so to your point, what goes down doesn't stay down, just the nature of cycles. I think we're in that bottoming process now, which means that, while conditions may feel super, flexible, super accommodative if you're on the buy side, everyone's contract rates are going down. Nobody blew their freight budget in 2023, at least it was set in 2022. Things feel super easy, and they are on a relative basis. But, what I would advocate is, don't get too comfortable, especially if you plan to be in your job for longer than the next 12 months. And when we're in the bottom of the down cycle, there's never a better time to pause and recalibrate, to pause and build capability, to almost kind of create that capacity plan before you need it. And so if you kind of think back, if you were in that position in 2021, think back as to kind of, okay, what happened, right? How did your carrier partners respond? Who held rates? Who didn't? What other modes did you consider? And so if you have freight that, based on kind of geography and transit time requirements and handling, theoretically could move over the rail if there was a financial reason to do so. Even if there's not a financial reason to do so right now, I think if you do that kind of pre-work and almost come up with a kind of a mitigation and a disaster recovery plan, so to speak, across your transportation network, kind of puts you in a much better position to execute that plan if and when you need it. And so on the one hand, you look across the different modes by which your freight could ship. It's intermodal, truckload, LTL, shared truckload. Look at the kind of the operating models in terms of the partners that you partner with. When we're in a down cycle, there's a huge tendency, in my experience, for a flight to assets, right? You think the assets are safe, right? They own the trucks, they employ the drivers, those trucks are going to be there kind of when I need them. And in many cases, that's true. But when things do get pinched, there are infinite assets. And so I would, again, encourage everyone to kind of think over that, 3-year time horizon and take a portfolio approach where across the different modes in which you could move your freight, with the different operating models, specifically private dedicated fleets, asset-based common carriers, or non-asset-based carriers. And I agree there's a time and a place for all of them. And that time and place may be different, based on where we are in the market cycle. And I think the third is you really kind of understand what's out there from a contracting standpoint. If there are different techniques or tools or technologies, types of contracts that your firm hasn't accessed in the past, I think now's a great time to kind of survey the landscape, understand that's what's out there, and bake that into your strategy, not just for 2023, but more importantly for 2024. And so you develop these capabilities before you need them, because when things get tough, and they will get tough, it's all about, you don't need to be there first, you just need to be there before your competition. So if you're first in kind of pulling some of those levers and deploying some of those mitigation strategies before your competition, you're able to service your customers much more effectively.
Yeah, and you mentioned the RFP, and it's a tool and an approach that we kind of talk about and hear about a lot from our customers. But the mismatch in sort of annual RFP cycles in this 3-year cycle that you just talked about, do you think that looking out a few years, say 3 to 5 years from now, that the annual RFP will still be the predominant mode or the predominant approach for negotiating contract rates? Or do you see some shifts coming in the RFP approach?
Yeah, I don't think the annual RFP is going away anytime soon, although I do believe its relative importance may fade. Again, we've got to kind of counter this tension between the desire to want to be predictive and be able to manage a budget, in a market that does what we observe it to do, at least a spot market. And so it's, both sides, both the buyers and the sellers, right? The shippers and the brokers and the carriers both desire that level of predictability. And probably a way that just doesn't exist, at least in the markets as they're constructed today. And I think on one hand, you have whether it's new forecasting technologies, whether it's AI or not, that I think forecasting we get better at, right, to some degree. But I think there's also kind of countervailing trends around just how freight flows in general, specifically around retail consumption, where it's a lot harder to predict freight patterns, right? As more and more retail shifts digital, and maybe it's not as much as we thought it was, a year ago as we're in the midst of the throes of COVID, where you've got more inventory piles in more places. You've got this, I think SKUs have much shorter, life cycles. You're kind of trying to target these kind of micro pockets of demand. And that makes certainly supply chain planning, but especially transportation planning, that much tougher. And so I think you kind of have these two trends that are kind of at odds with each other. That doesn't make things any easier. And so I think, to make a long story short, I think that there will be pockets of consistency, at least within most high volume shippers networks, where that freight is more predictable. And it is realistic to go out and run an annual bid and be somewhat confident that that freight is going to flow the way that it's out there and it's presented out in the marketplace, that carriers can engage and not overprice too much risk into those contracts. But instead of that representing maybe 80 to 90% of a shipper spend, maybe it ends up being 40% or 45%. But that 45% is going to run relatively on schedule, so it's maybe less you have to worry about. And so the freight that no longer fits into that predictable category, the question is, what do you do with that? And within that, maybe middle tranches of shorter term bids, more flexible bids, some of the stuff that I know Leaf is out there working on. And some freight you just may be consigned to, it's going to move in the spot market. And I believe the range in which those rates will float based on the forecast of where the market's headed will be within X and Y. And that'll be okay. You're not trying to force fit freight into a procurement model that's not suitable for that freight.
Yeah, no, that's we often talk with shippers about sort of taking a portfolio based approach and not assuming that all their freight behaves the same. But empathizing a bit with the poor logistics service provider here that you just kind of talked about several challenges that make things much more volatile, and uncertainty is very much the name of the game. What could a logistics service provider do to make their business more predictable given some of these factors that they're facing?
Yeah, and again, I think a lot of the tactics or the approaches I would recommend for shippers on the buy side, aren't that different from the carriers on the sell side, especially the carriers with assets. Your non-assets got a little bit easier, right? That's the whole point of maybe non-asset, because you don't have the same kind of challenges, with meaningful investments in trucks and drivers and infrastructure. When you're making those investments, you on the one hand, plan assuming this cycle exists. And I think part of what, again, drives the magnitude of the peaks and the valleys is that when, times are great, the economy is rising, the freight market's strong, think 2020, 2021, spot market rates are at record levels. It seems like a really good time to add more capacity and buy more trucks. And even if you're not buying, net new, you're planning to send your old trucks, back out into the secondary market. We're still bringing new capacity in. And so from a high level standpoint, make those capital investments at least on a 3-year horizon with some general understanding of the volatility that's going to define the market over that period. Certainly what goes down eventually, right, comes up. But I think take that in your planning process. You don't get caught, making, very suboptimal long-term decisions based on short-term information. And I think beyond that, it's, I think be picky with your partners. And I think be intentional with the segments and the industry verticals that you seek to service, based on your unique, talents and capabilities, and things you do better than the competition. And then don't get greedy. And then kind of within that, it's, look for those pockets of consistency and look to really drive alignment with those carriers that have, or the shippers that have more consistent freight over the corridors and the geographies in which you service, and then develop the tools and capabilities to manage the volatility around that. And whether that's with more flexible contract terms, just like the buy side, or, just consigning that some portion of your network will likely be exposed to the spot market. And then what is your strategy for dealing with that?
Yeah, so there's this interesting phenomenon that you talked about in your research in Q4 in 2022, and you talked about buying shiny new trucks, something that folks in our industry love to do. But in your Q4 of 22 research, you noted that we were at a low point in terms of rates, and yet while being in that trough from a rate standpoint, tractor orders were up over 100%, over 120%. Is that an indication of just sort of pent up demand that we needed to get sort of these trucks back in replacement cycles? How do you attribute that sort of trough and this investment in brand new assets?
Yeah, I mean, since 2006, 2007, I've been tracking these markets. By far the most consistent correlation was with the year-over-year journey of spot market rates and the year-over-year change in net Class 8 tractor orders, right? The rate at which the industry is placing new orders. Doesn't mean those trucks are showing up. It's more of a sentiment indicator. I feel good. I'm going to place the order such that 6 months, 12 months, 18 months, whatever those build cycles and backlogs look like, new capacity, right, comes into market. And so that was almost like clockwork, right? The quarter at which spot market rates went deflationary, you'd see deflationary, net tractor orders, and then vice versa, other side. All up until we got to this particular cycle. And certainly the COVID-related supply chain disruptions, where we stand, had a very material impact on that. Whereas we were, going through the market cycle, towards the end of 2021, before the market broke really negative in a very big way, Q2 2022, at least from a rate standpoint, you actually started to see weakness in tractor orders. And a lot of the narrative was, well, that's not really a reflection of market demand. That's more a reflection of the build capacity for the OEMs that are building these trucks. And a lot of them closing their order books, right? Because they couldn't take more orders. They didn't really have any visibility as to component supply, sub-assembly supply, the actual means to build these trucks. And so this time around, you saw a bit of a 2-quarter kind of dislocation in that pattern, right? Where orders broke negative 2 quarters before rates did. And you kind of scratch your head and say, well, that's interesting. Do we think that's a signal? And so Q4 of 2022, as we're seeking our trough, the market's down 30% year over year from a spot line haul standpoint. You saw this wild surge in Q4 net tractor orders, which is what you're referring to, where you expect to see a negative bar. That January bar, sorry, the October bar came in at plus 126%. once the quarter closed, it cooled off a bit, but it was still 86% year over year in peak levels of deflation within the spot market. And so the question was, okay, is that a signal where, hey, this is the same 2-quarter heads up that we got last time around? Could this serve as a 2-quarter heads up as to we're going to hit our bottom and the market's going to break inflationary? I think the punchline is it's too early to tell. I think the question is going to be what happens in this Q1, and will Q4 prove to be an anomaly? I think if we close this Q1 on another inflationary read, then okay, I think more optimistic that's a signal, and we're looking for an inflationary spot market by the end of the year, if not sooner. If we break negative, then yeah, it's noise potentially, or a bit of a head fake. And with January and February close, right now we're sitting about +3%, +4% year over year. So it's flat, which is super frustrating. And so I think as we look at it, you depend on whichever side of the x-axis, right, that we land, whether we're up or we're down. I think we're pretty confident. Let's say we end up, then we're looking at an inflationary spot market by as early as late Q3. If we're down, then it possibly pushes out our curve by a quarter to kind of Q4, right, Q1. Okay. So long story short, it's this stuff's super complex. I think a high number on the track orders is super. I think it's definitely positive for the industry in terms of that level of activity. It means order books are open back up. Some of the supply chain disruptions that hampered the OEM builders appear to be resolved, and it's possible that going forward we get more of a true read on market sentiment, right? That's not made opaque by just the unique challenges during this particular cycle with what's happening on the truck build side.
No, those are really very helpful thoughts to kind of as we look out in the market, and timing those shifts is pretty difficult for everybody. But at the same time, people do have to set annual budgets, like you said earlier in your comments. So as a shipper who's kind of thinking about, yes, we got to get through 23, but I'm being asked to opine on, setting budgets a few quarters or maybe even a year, calendar year 24. How should they be thinking about the next 3-4 months as they start planning for the longer term? Because they're getting these requests, like they always do, to kind of look out and, peer into their crystal ball. Sure.
Yeah, and I think what we haven't touched on is the fundamental lag between contract rates and spot rates. So while we're down here at negative 30%, in the spot market looking for our floor, expecting a turn, typically contract rates lag by about 2 quarters. And so contract rates just now broke negative year over year this quarter for the first time since 2020. And they're just now starting their kind of free fall and correction. And so every shipper that was out there bidding with their annual bids, or depending on what their duration is, are seeing rates come down. And we're in this period of a race to the floor where brokers and carriers to some degree, many will just be bidding whatever they have to bid to get an option to take the freight and then turn it back once market conditions turn. Not saying all buyer and seller kind of behaves this way, but that tends to be what happens during this leg of the cycle. And so I guess the point is don't get lulled into a sense of complacency. I think definitely take the cost savings now while it's available, depending on your strategy. Don't turn that down. But from a 2024 budgeting standpoint, would for sure be building in a level of inflation somewhere in the neighborhood of upwards of 5 to 10%, depending on how much of your freight tends to ride on a contract line versus spot line. I think we'll start to see some real pressure on routing guides, really as early as Q4 of this year, and start to see some evidence of some of that freight coming back, carriers renegotiating, primary tender acceptance, starting to erode a little bit.
No, I really appreciate that. I think that's very clear guidance for what to watch out for and what to think about from someone who's watched a few of these cycles come through and keeps looking at the data. So thank you for that.
Absolutely.
Great. Thank you both so much for the conversation. I think you've given our audience a lot to consider in the months ahead and things to watch out for. Chris, can you give the audience a little overview of what you're working on and where to find you? Yeah,
so I write a monthly kind of research note under Pickett Research at pickettresearch.com. But my real job is as chief operating officer at Flock Freight. So Flock is a technology company really creating a smarter, more sustainable supply chain, and we do that through really the introduction of something called shared truckload at scale. And so we've got patented tech that's really built to find empty space on trucks and fill it. We certainly have a theory, and it's backed up by a lot of research, where 30 to 35% of truckload capacity today out in the market goes wasted. It's underutilized. Where you have shippers that are tendering those loads to carriers or brokers just because your truckload rate's cheaper than your LTL alternative. So what Flock has built is a large, dense network of shipments that we look to pull together in multi-stop truckloads that drive much higher utilization. And so think, asset-based, conventional, less than truckable without the actual asset-based terminal network. And so we're building multi-stop truckloads, pooled truckloads in the cloud, using tech. And so the upside for the LTL shipper is there's certain LTL shipments that would benefit from moving faster, right? You're bypassing, right, the hub and spoke network, would benefit by getting touched less, right? It gets touched once on the truck, once off the truck. Would benefit by emitting less carbon in the atmosphere because it's a much more efficient mode of transportation. Shared truckload is an option. For those truckload shippers that have freight that, it rides, 10 to kind of 40 linear feet, it's almost too big for volume LTL, too small for truckload, creates a platform to, really source full truckload transportation, but only pay for the portion of the truck that you actually need. The upside for the motor carrier is we prove you can make more money hauling multi-stop Flock shipments, and also creates a platform to come and get, partial shipments to maximize the trailer utilization on the assets that you operate. In a way to, again, also take a ton of carbon out of the environment for those underutilized, full truckload movements.
Wonderful. That's great. Anshu, can you give us a little bit of background on what you're working on?
Sure. Yeah. So Leaf is fundamentally in the business of planning, scheduling, and coordinating freight across multiple parties. So for our shipper customers, that means using their demand as part of a much larger grid, that's our transportation grid, and effectively reducing that deadhead that happens before and after the shipment that they predominantly care about. By knitting together multiple shippers, we allow shippers to get more reliability in cost, service, and reduce the emissions associated with empty miles. And the same sort of reliability benefit comes for our LSPs, who are able to more predictably get freight that works for them. So kind of along the lines of what Chris talked about in the conversation today, bringing reliability to both sides so they can manage through these cycles of volatility, and taking this sort of win-lose mentality and making this more of a winnable game.
Great. Thank you both again. For those of you looking to connect, you can find us at flockfreight.com or leaflogistics.com. Thank you all.
Thank you.
Sure. Thanks, Anshu.
Thanks.